74.70 level. As you see, there are several lows down there or very close to that. I've identified that as the low of the multi-day trading range. What we got out of there early in the week was short covering. The market got very short down there, and you got short covering. And what happens when you get short covering so often is momentum traders that look only at price think the market is strong. Yesterday morning's rally was as weak a rally as I have seen in probably 2 years. Price was going straight up. Almost every reference was weak, meaning it's coming from an exacting level, either a previous, the prior 30-minute low or half back or something like that. That tells me that it was short-term money, weak hands traders, but it wasn't joined by any good, solid money. Of course, that market gave way late in the day. Now, overnight, we've got this huge sell-off and gap lower, and we're down below. It's a breakout level down below that 40, that the level I just mentioned. What is that? 70, the 74.70 level. So the tremendous risk in here because of the market being this short. So what this is what I call a go, no-go level. In other words, at this 74.70 level, at least the way I see the market, it needs to break below that with authority or get rejected from that level and trade back above the 74.70 level. If it trades back above that level, you want to see that if it's really buyers, you want to see that the market gains some strength and really starts to elongate to the upside. So it's a very important level. It's one of the largest gaps I've seen in some time. It's no more difficult than that. Now, what I have done on this market, because of the volatility and particularly summer trading, when the market got down, and it looked much earlier, it looked like it was going to test that level. I employed the strategy that I think is one of the worst strategies that you can use, with exception. And the exception is when there is extreme volatility. I bought a straddle, which, like I say, is normally a very, very poor, very, very poor strategy. But because of what I thought is possible volatility, it's what I did. As the market broke down here, I sold another put against the long put, and locking in. I could give up some profit, but I've locked in a profit to the account. I don't want to talk about strategy other than just to tell you what I did, and tell you it's a terrible strategy with exception. Okay, so right now we have a go, no-go level. It's a huge gap. I am using that 74.70 level as my go, no-go situation. I'll take any questions you might have.
Good morning, ma'am. I don't have any questions this morning, just because I think we surprised them with your appearance.
Okay.
Does anybody have any questions this morning? No?
Okay.
No, I guess not.
Let me leave you with, I think, what was the most important piece of information, and that was yesterday morning's early rally. That rally was so weak, even though price was going higher. I mean, it was almost frantic-like buying, but it was extremely weak. And so many times, traders that look only at price are terribly disadvantaged in the market. My latest book is really how profiling gives momentum traders an advantage. In other words, momentum by itself doesn't have any context. When you put the profile around it, it allows you to see how those rallies or breaks are occurring. that gives you a deeper understanding. And yesterday morning's, well, first of all, I had started focusing on this area when we had this non-excess low from around, I don't remember if that's 7.7 or 7.8. And I think, Jenny, you heard me talk about that at one point in time. And so that was had my attention several days ago. And then that's not uncommon for the market to try and rally from there because they see that as, good trade location. But when there's no follow through, and yesterday morning was just so very, very weak, it was looked like panic buying, and that was said, be careful. All right, let me say thank you. I hope you have a great trading day. It's going to be a strange market. It's a huge break. Thank you very much.
Jim, wait. So they're asking counter trade above 70.70 and continued sell below 70.70.
I'm sorry, one more time.
I guess they're asking about the 74.70 line. If you don't see a reaction at the 74.70 level, what's the next target?
I don't have anything. The next, I mean, it's so far down there. If you look at, I think it's 629, look at the low on 629. The low on 629 is exactly at half back from the 26. When I see that is weak buying because it's coming from an exacting level. So if I had any, if the market really broke, that would be the level I would be looking at. I mean, that would be an exceptional break. But, these things do happen in markets, and particularly in the summer when the markets are very thin.
What are the chances of a counter auction in the morning with a gap like this?
It would be, I don't know. I don't know. There's so much emotion. There's so much emotion in this market, and the gap is so huge. All I can say is that, remember the general rules, the gap trading guidelines. Go with all gaps that aren't filled fairly quickly. Secondly, overnight inventory, 75% odds that you get a counter auction relative to overnight inventory. And remember, if you don't get that counter auction, that's a sign that the market's really weak. So in other words, this is short. If you don't get a strong counter auction to this short overnight inventory, that's a sign of real weakness in the market.
One more question. So great to have your sober analysis on this emotional move. Thank you.
Okay. Thank you, guys. Have a great day.
Thank you so much, Jim.
All right. Bye now.
Bye.